If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Hey, Emma, welcome to the show.
Hey, thanks for having me. It's good to have an opportunity to catch up with you. It's been a while.
Yeah, I'm so excited. No, it's probably been close to 12 months, maybe not quite, but pretty close. So selfishly, I'm just excited to catch up, but I also know the listeners will get a lot of value just from that. So if you don't mind, just give a little background of who Emma is, where she came from, and how she got to where she is today.
Real estate wise, I've had a goal to retire on passive income. And that's taking me down some twists and turns, and some of them are feeding that goal and some of them are detracting from that goal. And so I've just spent the last, I think probably 4 years, trying to sort out the fastest way to get to this goal. And obviously in doing that, you're going to take some side routes that maybe weren't the best idea, and just learning from that. So started, investing in residential real estate in 2018 with always the goal to go commercial. My husband grew up in a college town, and so a lot of their friends and neighbors while he was growing up owned small apartment complexes, 12 units, 20 units, things like that. So for me, it was like not a big deal to be like, yeah, we could probably buy one of those. And our daughter was going to college in the same town. And so we started looking into that. And in the meantime, a few residential deals fell in my lap. I was trying to do a few flips, just make some more cash. Ended up keeping them as rentals. And then when we finally found our first commercial deal in 2019, we closed on early 2020, literally right before the shutdown. I think it was like beginning of February. We were just starting to hear about COVID when we closed. Anyway, so have just spent the last couple of years managing that asset. We still own it. And then purchasing a couple of more, all again in a way to just speed up the pile of cash. And so this year's goal, 2022, has been to take the equity that we earned in those properties, or the cash that we earned when we sold them, and convert that over into passive income, because it's not automatic. You can't eat equity. Equity doesn't spin off cash flow. So we're trying it would be nice if it did.
Yeah.
I knew I needed about $1 million of cash invested at roughly 10% to make about 120 grand a year, which is 10 grand a month. That's like a first base of simple retirement, replace my husband's W-2 income. And then when we got to that point where I had enough equity that I felt like, oh, none of this is kicking off passive income, and I'm doing these active deals, which takes time and effort, and it was never really part of the plan. It was just trying to amass the cash that we needed as quickly as possible to get retired. And so now that we have that equity in place, we're slowly figuring out how to reposition that into maybe other people's deals so that it comes in more like mailbox money, passive cash flow. So that's been a process, because I realized I don't know how to invest for cash flow. And it's definitely two different things when you're actively investing for rapid profit or appreciation versus just taking cash that you have and getting that invested for cash flow. And so it's an entirely new segment of real estate investing that is a lot more different than I realized when I first started down this path. So that's what I have been up to lately, and kind of where I got started, and where, that path that has taken me, and having to constantly reassess, like, is this getting me closer to that goal, passive income retirement, or is it detracting from that goal?
Yeah. And to your point, the whole cash flow thing, it's getting harder and harder to find, cash flow deals.
Mm-hmm.
Like probably 3 to 5 years ago, it was really easy to find cash flow deals. You could also pretty much just be like, not know what you're doing and still find a cash flow deal, but it's getting really tough. So, and listeners, what she means by, the cash flow and being a passive investor is like, to truly be passive, you're pretty much just exchanging, you're putting your money into a deal, and then it's spitting off some type of return, whether that's monthly, quarterly, and you're not putting any work. And when she was saying active, that means she's actively finding the deal, putting the deal together, and then managing the deal. So that even though a lot of people will say, yeah, real estate's passive, it's only passive if you take a passive position. And I think that's important to stress, because it's a very, very not passive when you're an active investor. And I'm sure Emma can get into that right now. So what type of commercial are you doing, or have you done, and what are you doing now?
Well, we are doing just commercial multifamily, and it's not like I'm opposed to other forms of commercial real estate, but I think sometimes the first deal that you find is it's almost like getting typecast. I was actually looking for self-storage units back. We lived in Austin for 20 years, and one of our neighbors built ground up storage facilities, really nice, climate controlled, Class A types of facilities, and we had a few of them around where we lived. And at the time, I didn't realize, what a rock star that made him, but we would go and talk to him about it. He was always trying to encourage us to get in on that. Right. I just don't think we were ready. Like, I was like, well, where do you get the money? Did you raise it from investors? And we were like, oh, I don't know how to do that. And so he was always kind of pushing us to find a deal and tacitly told us that if you find one, I will back it. I'll partner with you. I'll help raise money. But we just didn't understand how the process worked. And so some of the things that he was saying and offering just didn't make sense to us. And we ended up never doing that. We did buy a piece of land. We bought 5 acres with the intention to build a self-storage unit on it, but we were trying to do it all in cash. And that our neighbor came to us one day and she said, hey, I'd like to sell the 2 acres next door to you. And we had a little mobile home on it. She's like, I'll give it to you for 60 grand. And this is right outside of Austin, about 2 minutes off of I-35. And we turned her down because we didn't have the cash for it. Like 60 grand for 2 acres of land. It was just such a good deal. So we had her, we turned that down. We had this guy trying to teach us how to do storage units. We didn't get it. So we weren't really leveraging that. So when we got to Salt Lake City, when we relocated and I started looking at getting serious about real estate investing, that's when we were looking at my husband's family, friends growing up, that they own these little apartment buildings, and going back like, oh, we totally wasted that opportunity to learn the self-storage business. So we started looking for self-storage, and then we ended up in multifamily because somebody in my network had a building for sale, and I didn't know how to run numbers or do anything like that. But I thought, it doesn't hurt to look. And I did want a little apartment complex, kind of in this general geographic area in Southeast Idaho, where my husband grew up. And so we fell into that one. And then after that, it was like, oh, well, now I know how to do this. Let's keep doing it. And I would love to do some other types of commercial real estate, but I really get multifamily and have really niched into that, especially the heavy value add. And so that's just what we continue to do. So we do have one new development under our belts that we just sold. But other than that, it's really been all multifamily.
That's awesome. And what's that development that you just sold?
Like our flagship project. I would love to find another project like this, but we purchased a couple of warehouses and some rundown houses on a block in downtown Salt Lake City, and put together the entire project as far as the entitlements and the design go, and the first stages of demolition with some other local like commercial contractors here in the area. And our general contractor that we brought in for that one, he was going to sign on the loan, because when you're getting a loan that huge, they don't just give it to anybody. You need to have a net worth that's equal to the amount that you want to borrow. So we found a partner who was going to build it, and they were going to sign on our loan, which is really common with large commercial contractors. It took us a while to find the right one, but eventually we did. And they brought in an equity partner that wanted a little bit more equity than we were willing to give up. It would have tied up our cash for too long. And so we asked them to buy us out. And so they made us an offer, and we just sold that in December. So we demolished it. I just drove out past it a couple of days ago, and it's just about ready to go vertical. They're finishing up some permits and things like that. But we did most of that project except for the vertical part of it. So the next one we would really like to find similar and go vertical with that one. It's definitely 2 different games, the entitlements and permits versus the actual construction. But if we can find another project to get involved in, we would definitely do that one again any day of the week.
That's awesome. Yeah, I remember the early stages of that when you were talking about it. So that's exciting though. And it listeners, it just shows like anyone can do this. Like, Emma, how big was that deal going to be from a development standpoint?
By the time we finished buying up the block, we did it in a couple of different phases because, you got to get each neighbor to agree to it. By the time we finished, it's about a half an acre. It's about 160 units. It's a 6-story high rise with 2 layers of parking. And I think that you're right that I'm a stay-at-home mom with homeschooled kids. I don't have an office. I don't run a big business. I have no employees. I don't have a virtual assistant. And so it's really just a mom and pop or solopreneur type of business. You just have to know the right people. And in that point, like right before we closed that land, it was December of 2021. No, it's December of 2020 is when we closed that And even about a month before closing, I still had no idea how I was going to pay for it. And I was panicking. I had about $35,000 worth of earnest money on the line. And I didn't know how I was going to close it. I had a hard money loan, but we still had a down payment of, I think it was $500,000, somewhere around there. And I didn't know who it was going to be. And actually, it was these podcast interviews that helped me find those partners. After a podcast aired, somebody called me and he was like, "Hey, I heard about your project. It sounds amazing. I'd love to partner on it." And he brought in, I think, just $500,000 by himself. And then we had another partner for like $250,000 and got that thing off the ground and got it working. But I thought I was going to have to let it go and lose my earnest money. I mean, that's just the risk of the game. You know, we did lose a deal that we tried to do in Texas last spring, and I lost about like 70 grand on that one. Yeah. So it's definitely not without risks. I don't want to say, oh, anybody can do it. That's easy. But you know, every dime that we make from selling a property, or I've never flipped a property, but if you're flipping or something like that, every dime goes back into the business. And every single time you do a deal, there's a risk of losing it. So yes, anybody can do it. Yes, it's possible. You don't have to have any credentials or a big business or anything like that, but you do have to be willing to figure out where you're going to find the money and be prepared to guard yourself against that risk. And on the upside of that, you know, we sold that property last year. We sold 3 properties last year, and that loss really made it so I don't have to pay any taxes on my capital gains. So it all evens out, right?
Yeah. That's like a common theme I see in successful people like yourself and people in other industries as well, is that they're able to, you know, take a bite bigger than they can chew and then figure out how to chew it. It just seems like
joke on it.
Yeah, exactly. Sometimes you do, but then the ones when you figure it out is makes up for those moments of choking, right?
Yeah, definitely worth it.
But it's still so inspiring though, right? Because like you said, you know, you came from a different background, you know, you stumbled and then found success. And to most people, they would think you would probably have 10 plus years of experience in success before you took on a big development. But Emma said no. And she's like, I want to develop. And just to me, that's really inspiring. So kudos to you. And I know you're going to find another one and take it all the way. And that's just, I can't wait to watch that. But so what's next? I guess like the question that would probably come to most people listening would be like, okay, but how can you like put all that money together? And I know you're good at this. So how have you been able to raise money, and how are you now raising money?
Well, there are the typical avenue of raising money. You got 2 options. You get a couple of rich people together, like what I did for the downtown deal, you know, had almost $1 million between 2 different investors. And you put a bunch of rich guys together and you go and do a deal in some sort of a joint venture. So we created an LLC. They got equity according to their experience and their work that they were putting in addition to the money that they were putting in. So I think I put maybe 100 grand or maybe 80 grand into that deal. And so I got a lot smaller percentage of that deal because they put in a lot more money, but they also ended up in the end doing more work than I did. I'm good at setting it up and teeing it up. But then for the day-to-day management, some of the details, I have to delegate that out. And so because they're commercial contractors, they ended up doing a lot. So that would be the joint venture with experienced people who have cash. Another option is syndication, which has not been as successful for me. Syndication technically could encompass a joint venture, really any time that you're taking different people and adding up what everybody has to put in the pot and then going out and doing something. But I'm talking about syndication from the standpoint of doing like an SEC fund where you raise money from limited partners. So definition of a limited partners, most people know, is somebody who's putting money into a deal, but they're not putting any work. They're basically making money, a return off of their cash that they put in through the efforts of others. So a debt note would be considered, the debtor, you know, the lender would be a limited partner technically. And there are securities laws surrounding how you issue debt notes. Each state has its own rules, but you have to be aware of what that is. And so what we would be doing is raising it from equity partners, selling securities is essentially what we're doing. And people like me who have a little chunk of cash and they're trying to passively invest would put that money into the deal And then they're going to earn a return, even though they have no voting. It's really like buying a stock. I mean, you don't control how that company, what that company does. You can watch, you can pay attention and all of that, but it's not a liquid investment. You can't pull it out anytime you can. Like with the stock market, you really have to vet these operators pretty hard and make sure that they're going to take good care of your money. Because at the end of the day, when you put it as a limited partner, you have no control. And so me syndicating by attracting limited partners has really not been a great avenue for me, because I don't have the right network of people who have jobs and they have other things going on, that they want to put money in as a limited partner. Because I spend most of my time with other entrepreneurs and real estate entrepreneurs, and most of the non-real estate entrepreneurs that I hang out with are so busy building their own business and throwing capital back in their own business, they don't have the time or the extra liquid cash to put it in a real estate deal. And they always are saying, oh, I need to get into real estate. I just don't have time to learn about it. I don't have time to. So I've slowly and painstakingly been trying to create an education that busy people can absorb and still feel confident to put their cash in. But at the end of the day, most of my network are other active real estate entrepreneurs, and they don't want to be limited partners. They want to be co-GPs or co-general partners. And so I was complaining about this problem to my securities attorney. We actually did a deal together on a small apartment complex up in Idaho. And he did our legal work on that as part of his equity input on a joint venture. And I was telling him, I said, I have phone calls, I have meetings with people that I met when I did a podcast interview, or people I met at a conference. And they come in and they're like, hey, I've got 100 grand or 200 grand. I would like to co-GP with you. And the size deals that we're doing, it's like 100 grand, that's like limited partner territory.
Right.
You want to buy your way into a general partnership, you're looking at minimum 300 grand, usually more like 500 before they'll even have a conversation letting you in to a deal like that. Because really you're there as the rich guy who's putting money in, and you might not have anything else to offer. And so I was like, we're raising $5 million, $6 million for a deal. I can't go co-GP with everybody who has 100 grand, because here's another rule. If you have a 15 or 20 people in a general partnership, how many of them are actually running this deal? Only a few of them. Right. If you have a group that huge, most of them are putting money in and they're not doing any work. So they're technically buying a security. And these little token jobs like, oh, well, you get to vote, or you get to, that doesn't count. And that's going to get
investor relations.
Exactly. And the SEC, the state SECs, most of the federal SEC takes care of all the paperwork and filing and setting rules. So the states, each state has its own SEC, and their job is to investigate specific deals and make sure that they're compliant. And so they're looking at stuff, especially if there's a complaint, but sometimes they just call people up randomly because they're on a lot of podcasts, or they have a website, or they're putting themselves out there, and the SEC is like, let's look and make sure they're doing this legally. And so you can't have 15, 20, 25 people in a deal, because that's just going to get the flags of the regulators, red flags going. They're going to investigate that. And you know what they're going to find if you have 15 or 20 people in a deal? Not everybody is doing something legitimate. And so I was complaining to my security attorney, like, I cannot use all this cash. I have millions of dollars worth of cash from other entrepreneurs who are like, oh, I want to put in 100 or 50 or 250 or whatever into a deal. And I said, it just gets huge. And he said, well, what you're sounding like is an investment club. I was like, what is that? I'd never heard of that before. And then going and researching it afterwards, he sat down, we had a meeting with him and his partner and just went over investment club rules. It's mostly people who are buying stocks together back in the days when it was $10 or $25 for a trade. And so if everybody's buying a little bit of stock, those transaction fees add up. So they would pool their money and they would make a single transaction for $10 or $25, but maybe they had $1 million pooled. And it was a way to get lower transaction fees. But now that you have websites, Robinhood, M1, where they've got low cost or free trades, the investment club really doesn't have much of a use anymore. And so we found this website called TribeVest, and it's basically pooling your capital to go in and do investments together. And it's a whole platform for managing all of our corporate governance and our banking and all of that. So when we found that and marrying that with the idea of the investment club for my attorney, I said, well, maybe we can give all of these people who have 100 or 200 grand an opportunity to co-GP. Because when you're bringing in $500,000 or $1 million into an investment as a group, there might be 10 or 12 of us in that group. But because we brought it all in as a unit, in a club structure, we want to have something beyond just being a limited partner, because we want to protect that investment.
Right.
We want to be able to have voting. We want to be able to have oversight. So we'll go in and negotiate for non-managing GP shares. And it's just a small percentage. It basically just boosts our returns by a small bit. We have some costs of doing business, like legal fees, and we have to file an annual tax return for LLC, things like that. So it boosts our returns a little bit, not tremendously, but it gives us the power to get in there and be in on the asset management meetings and to really listen and affect what's going on. So for example, we just did our first deal as a club, and we're listening in all the asset management meetings. We have access to all the back office documents and systems, and we're able to say, hey, we're not going to be inappropriate and do it during a meeting, but we can send emails or text messages or have phone calls with the sponsors in a way that a typical limited partner would never be able to do. And so for us, it's been fantastic, because the main reason is we're in there protecting the money we put in, but secondarily, we're able to get asset management and co-GP experience, which gives us a lot of credibility when we are going out and raising money for our next deal, or trying to get attention of brokers when we want to make an offer on a deal, or lenders if we want to sign on a loan. And so it's really building the group's credibility. Now we own just a sliver of the
They
deal.
don't care though. And a broker wouldn't know.
Exactly. And so we're just grouping up with other experienced sponsors they're happy to have our $1 million. And like I said, when you're bringing in $500,000 or $1 million, they're like, what do you want? And any fund is going to work this way for donors, participants, making it sound like it's charity. But for people who are bringing in larger amounts of money, the fund will have built in some extra perks that they can give that investor, like lower asset management fees, co-GP shares. They can give them a better return. They're going to share in the promote, which is the extra that the GPs get if they do a good job. That would be the co-GP shares. There are ways that they can entice people to bring in larger amounts of money in order to get a big group in. So we're just doing that in the club setting.
That's really interesting. So just to make it clear for everyone, so essentially you're creating an LLC that everyone in the investment club has ownership of, and then that LLC is what is the co-GP on the deal itself.
Yes,
That's
from a legal
awesome.
standpoint.
Yeah.
So we have a couple of hundred people in the club as an informal meetup. I can't even really call it a capital C club, because the SEC, the way they define investment club, are people who are actually putting money into a deal. So when we create an LLC, it may only have maybe 10 to 12 people from the meetup are coming in and investing in this thing together. So that's the legal club, is that smaller group that goes into a deal together. And
then are you creating a new LLC for each deal? Because it'll probably have different investors, right? Like not the same people are going to invest in every single deal.
Yes. And there are upsides and downsides to that. So the club may eventually one day start a fund, which is basically an SEC document. Those are 15, 20, 30 grand to create. So there's an upfront cost, but depending on the attorney that you use, they may allow you to delay payment of that. So the first 20 grand you raise goes to pay the attorney. And so they're not looking for that up front. So that's a benefit. You can start a fund and put that formation cost as an expense of the fund. And that would really give us a lot more latitude on being able to go out and raise money and not worry about the structure of what the sponsor, are they 506? Well, you do kind of have to worry about it a little bit. I don't want to get too far into that, but we could start a fund, which would give us some more options, because then it wouldn't have to be a new LLC for every single business, every single deal that we do. But the advantage of doing it the way that we're doing it is our LLCs through TribeVest are actually very affordable to set up. But once you get a bunch of them, it's like you have to file a tax return for each one of them every year. And TribeVest doesn't help you with that part. You need to get your own attorney, and they issue like the deal sponsors will give us a K1 every year. We get one K1. And then we give that to our accountant, and then he issues the multiple K1s to all 10 of us that are in the club. So, and each K1's like, I don't know, $100 or $200 to create. So like I said, there are some expenses and there are definitely some downsides, but the upside is we don't have to start a fund to do this, because the operator already has a fund. They already paid their 20, 30 grand to their attorneys to set this SEC exempted fund up. And so we're just putting our money into that as limited partners, and straight into their fund, right? But then our LLC is negotiating some co-GP shares in order to protect that investment. But each club member has to sign their own PPM. They have to wire their own money. They get their distributions individually. We're all limited partners individually. It's only the LLC that negotiates for the co-GPs where we're doing anything jointly.
Oh, okay. That makes sense. So the LLC, it signs the operating agreement, but not the PPM. The PPM is signed by each individual investor. Oh,
Yep.
that makes a lot of sense. All right. And then TribeVest, I think what you called it, that actually creates the LLC for you.
Yeah, and you could create your own or not, and they have several options, but we chose to go through them. And then we found an attorney in the same state that where our LLC was organized, and just paid him a fee to review our operating agreement and also just to do an SEC compliance check, because I haven't heard of anybody doing it for this purpose. I spent months trying to find a group that was already doing it this way, because sometimes you have an idea and it sounds like a new idea or a great idea, but then when you go and do some research, you realize that other people are already doing it. And so I didn't want to start a club or mess with any of this. I just really wanted to find somebody else who was already doing this, and I wasn't able to, which is why we started it. So I really felt like we needed a compliance check. So we had him review all of our documents, our business plan, and just come back. And he gave me some disclosures that we needed to add, some operating agreement stuff we needed to add, things like that, just to make sure we're really drawing and coloring inside the lines on this one. Because if my goal is to retire on passive income, the last thing I need to do is raise money illegally and go to jail.
Yeah,
That's not the
true.
retirement plan I mean.
No, yeah, that's a passive lifestyle, not the one you want.
Yeah. The white collar country club.
Yeah. Oh man. That's very interesting. So say you raise $1 million through that LLC, that co-GPs, and say the minimum investment for the deal itself is 100 grand. Does that mean each individual person that brings money to the LLC has to be 100 grand, or could they be less because you're totaling $1 million?
Yeah, so if they're accredited investors, there's really no minimum. So the suggested minimum is not in the PPM. It's like if the minimum is $50,000 or $100,000, the PPM doesn't say, hey, this is the minimum legally.
It's just the operating agreement that says it.
Yeah, and they have the discretion to override that. So
of course.
First time I heard about it was some operators. They owned a bunch of buildings, and they had some younger investors in their network, some kids just starting out, and they're like, I only have $10,000, but I really want to get involved in this. And they were able to just say, yeah, you can put in 10 grand if you want to. They were unaccredited investors, beginners, but they valued the relationship with these operators, and the operators are looking at, especially since they're younger, building them up to be like really trusted investors that really trust them over the years. I thought, oh, okay, well, I guess we can put in less. So I just go to the operators and I say, look, we've got some unaccredited investors if it's a 506B, or you have unlimited accredited investors. And so if they're going to put in less than 50,000, it doesn't matter. It's unlimited. The problem is when they're unaccredited, we're limited to 35 because we're each going in individually.
Yeah, so it could eat it up really fast.
It eats it up really fast. And so we had some unaccredited investors on this last one who were just really waiting to see if they could go in for less than the 50K. And we ended up being able to get everybody in, and we still, I think we only have like 29, and you can have up to 35 unaccredited investors in a 506B. And I hope people already understand terms.
Well, we can clarify in a little bit, but
yeah,
I think the minimum thing, like the way I look at it, is just a marketing scheme, right? Because there's people out there that will just put in the minimum. So if you say the minimum's 10 grand, then they're just going to put in 10 grand. But if you say 50 or 100, that's what they're going to put in. And it's also, maybe they can't put 100, but if you put it at 50, they would have done 50. But if since at 100, you say, oh, well, what's the closest you can get to 100? And then they go, oh, 75. All right, you can come. I feel like it's mostly just a marketing scheme for most people.
And now that everything's automated, there's a lot less reason to be having a minimum, because if it's not automated, getting everybody wiring instructions and PPM sign off, it's a pain. It's a huge pain. But now you have automated portals like Syndication Pro, Groundbreaker, Appfolio, Juniper Square, those types of platforms make it so this coming in is a fairly automated process. And so it's not as much of a pain to get people in. I think that's where the minimum kind of originated from. But the need for that, it's just like the same thing with the investment club trying to get lower transaction fees by coming in when doing a single transaction is a little bit obsolete. So is the minimum investment. Just ask. If you know the operator and you only have 15 grand you want to put in, just ask. And if you're an unaccredited investor, they may put you at the bottom of the waiting list, and you may not ever be able to get in, especially if you're working with operators that typically overfund very quickly. You may not be able to get in, but it's always worth an ask, and at least to get moved to the bottom of the waiting list.
Exactly. Yeah. Sometimes they'll do like, yeah, you could invest 10, 20 grand, but the 100 grand and above get preference. They get, automatic first align. But I've seen that before too.
Yeah.
That's a good point. Yeah, but I guess maybe we should clarify a little bit of the legal jargon of syndication. So I think most of my listeners know what a syndication is. It's obviously just, in layman's terms, pooling money together from multiple people to buy something that you normally would not be able to buy by yourself. So in this case, big apartment deals. And we're talking about, from the syndication itself, from a legal perspective, is you have to find a reason not to file with the SEC. So like a stock of a publicly traded company, they have to file with the SEC, that security. However, that's a very long and expensive process. So if we were to do that every time we wanted to invest in a deal, it would take 12 to 24 months and probably hundreds of thousands of dollars. So it just wouldn't work. So what you have to do is find an exemption from doing that. Yeah, exactly. And so there's something called Regulation D, where it's one of the exemptions, where what you can do is there's what we mostly use, Emma and I, are either 506Cs or 506Bs. And what that exemption is you don't have to, go to the SEC. You can just raise it from people that are either 506C is they're accredited, meaning all it means is you've made $200,000 or more in the previous 2 years with, pretty good confidence that you're going to do that in the current year, or you have a liquid net worth of $1 million or more, excluding your primary residence, or if you filed jointly with a spouse, that income number is 300,000. And with that, you can actually promote it and advertise it, shout it from the mountaintops, blast it all over social media. However, if you want to accept people that don't meet that accreditation rule, you have to do something called the 506B. But the caveat to that is you cannot promote it or advertise it. You only can, present it to people that what they call, a pre-existing substantive relationship. And I won't get too deep into that because there's this whole like 3-touch thing where how you can kind of, turn someone into that type of relationship, but that has to happen before you have any type of deal. So
yeah. I want to answer the question though. This is one of the most common questions we get when people are first learning about the club is, if I want to do a 506B deal with you, do I have to have a pre-existing relationship with the sponsors? And the answer to that is no, because you have a co-GP position. So and I don't even want to call it a workaround. General partners who want to put money into a deal can put money into a deal. Now, there is also, it depends on what attorney you ask, because I think the statutes are a little bit contradictory. But as long as the 506B deal is not advertised or generally solicited, it can pass from word of mouth to word of mouth. So let's say, for example, you have a 506B deal, you send it to me, whether I invest or not, I can say, hey, to my brother, and say like, hey, this is a pretty good deal. Would you like to invest in it? And you could take my brother in, because there's a
and I didn't know your brother.
Yes, a verifiable word of mouth chain, and you can prove that you did not advertise it. So that's why a lot of people, when they're on a 506B raise, they just don't even get on social media because they don't want to do anything that might be construed as advertising. So you do have to be very careful. And a pre-existing relationship is not defined by the SEC, and that's why it's sometimes difficult to define, because they don't define it. And some of the statutes that talk about it are a little contradictory. So we just
want to keep everything gray. The SEC wants to keep everything gray.
Yeah, it's almost like they're looking for it. It's tough. I mean, look at the trouble that Elon Musk is in right now with the SEC constantly, because Twitter, he criticizes the way that the rules that they make and the way that they're allowing us to do business. And I just, It's the regulators are there. There's nothing I can do about it. I'm obviously not Elon Musk. All I can do is when they have public comments for changes that they're looking at making is to make sure that I weigh in and make my voice heard when they're open for public comment. For the most part, we're not going to change anything. We're going to follow the rules. We're going to do what we need to do. And the more you learn about what those rules are, I'm finding two things. One, the less risk you take because you really know as much as you possibly can as a layperson how to do this correctly. But on the other hand, I just get more and more confused because the rules don't really jive. So it can be tough. But like I said, it's definitely worth a couple $100 here and there, $1,000 here and there to consult with an attorney. I think we met with I want to say 4 or 5 attorneys on the investment club. You know, my partner on a deal, he and I met with his partner. They did some research. Then I met with another attorney a couple of times. I've met with the attorneys of deals that we wanted to raise capital for. So they just put me on the phone with their securities attorneys, make sure we're doing everything right. And then our final attorney who actually drafted our documents and did our paid compliance check. It is worth spending a couple of hours with a securities attorney to make sure that you're doing this right. And the reason I met with so many is it was a little bit of uncharted territory. And I wanted to make sure that whenever they were all saying the same thing, that that's what we're doing. And anything that they said that was different, we were avoiding, because then that's open for interpretation. And this attorney says this and that statute says that. So we really tried to go with where everybody's in agreement. That's the path that we're going to forge down. So it is worth the money. Do not step over dollars to pick up pennies.
Exactly.
Don't get into anything to do with the SEC without paid counsel.
Agreed. And it's ever changing. Like there's a new rule now where you can start off as a 506B.
Yes.
So meaning you can't advertise, but you can take non-accredited, and then you can switch mid-raise into a 506C where you can advertise. But once you make that, the date you make that switch, then you no longer can take non-accredited. But if you had taken accredited before that date, they can still remain in that deal, which is very cool for future deals. But it's just to point out that it's ever changing and you got to be on top of it.
I really prefer the 506B with only accredited investors. And that is really a mark that your network is mature. Your limited partner network is mature. And the reason why is because of accredited investors are a lot easier to work with. And I'm not talking about from a babysitting or a psychology standpoint. I mean, from a legal standpoint. In a 506B, they declare themselves as accredited, and it's not up to the operator to determine that. So in a 506C that you can advertise, it's accredited only, and you can advertise it, but then the burden is on you to make sure that everybody in that deal is accredited. Whereas in a 506B that is private, no solicitation, no advertising, they tell you if they're accredited or not. And it's up to them in order to take the onus is on them to understand what that means and tell you. And yeah, if I see somebody doesn't really look accredited, I'd be like, hey, I don't really think you meet this. I'm not going to take people in that I obviously think they are, but they're borderline. We do help them kind of work through that. And there are services where they can pay I think it's like $100 fee, and they'll look at their stuff and tell them if they're accredited or not. And I would still do that on a 506B anyway.
Yeah.
You have to do it on the C. But on a 506B, it's not a bad idea. But if you're doing a 506B, accredited investors only, the paperwork is cheaper. The disclosures are a lot easier, I think. But you have to have a really good limited partner network in order to do a 506B with accredited only. And that was where the club was born from, because I don't have a great limited partner network. When I try to raise money from limited partners, it's always kind of a train wreck, because I just don't have enough people in my existing network to go out and say, hey, we have this wonderful deal. People may like the deal, and most of the calls that I get about it is, how do I co-GP on this? Because like I said, I don't have a great LP network. And I think if we want to shift gears a little bit, that would probably be the number one thing I would suggest people do if they're trying to learn, that they're learning how to raise capital. One, get yourself a limited partner network. And most of us just run around with other real estate investors.
It's so true. It's so true. Because we're just drawn to each other and it's easier, right?
Yes, definitely.
It's so true. And then, so what a lot of people end up doing is then they find other, entrepreneurs and real estate investors within the industry that solely focus on raising capital, and that's how they partner. And then it's similar to what Emma's doing, a little different, and then those people bring their LPs. So, but it's so true. You just end up going to these networking events, and it's just other active investors.
And there are benefits to that because they get real estate. They like real estate.
Yeah.
You don't have to get over that. Oh, real estate's risky, and I don't know anything about it. How do I read the pro forma? So pros and cons to everything, right? If you start out with people who know nothing about real estate, you're spending a lot of time just educating them about real estate before they're ready to invest. And so I think that having a wide variety of types of people in your network, what I look for is somebody who's maybe invested in these kinds of deals before.
Right.
Maybe they used to be an active investor like me, where they're trying to switch over to be just passive, and they're accredited. They've been to this rodeo before, and spending a lot of your time marketing to that avatar or that ideal client. And other people will fall into your basket along the way. But my problem is as I was marketing to my ideal client, which was an experienced limited partner who's just looking for more deal flow, I had all these entrepreneurs fall into my bucket instead, because I was casting the wrong lure, catching the wrong fish. And that's why I was so grateful when my attorney was like, try this instead. You can still put these deals together. And I think the beauty of it is, if you go back to it, that protecting our investment, and also gaining that experience and that credibility. Most of the people in this most recent club deal that we just did, it's their first time being a co-GP. And they may have spent $20,000, $30,000 on a guru, course, mastermind, boardroom, whatever you want to call it, deal room, military war zone, whatever you want to call it. And 2-3 years later, I've known them for a long time and they still haven't done a deal.
Yeah.
And they're frustrated because the learning curve and all the things have to come together with finding the deal, vetting the deal, raising all the money, and then running it. It's extremely difficult. And I think what some people who participated in the club and in the meetup, a lot of them realize, like, I actually don't want to do this. Like,
right.
watching it actually do it, it's hard. There's a lot to it.
Yeah.
And they're learning it from the get-go. They're like, hey, I can go and I can put 50 or 100 grand of mine as a limited partner. And we are able to raise capital in addition to that, because as GPs, we can tap into our own LP networks, and we can raise money from LPs. But most of us don't have big capital raising businesses. We can't bring in $500 or $1 million on our own, but we can as a team. And so most of them are out there doing their best to learn how to raise money, learn how to participate in this asset management. And a couple of them are like, actually, I'm good. I just want to be a limited partner after this, or just keep doing the club, because they're like, I actually don't want to build a big syndication business or capital raising business. So for me, and it was free. It was 100% free. We don't charge any money for the club. And so for us, it's like, if you put money in, you did a deal. Like, the only money that ever goes in is doing a deal. I can't guarantee that you're going to make money. I can't guarantee that you're not going to lose every dime that you put in. The only thing I can guarantee is you did a deal. Yeah. When you put your money in, you now have that experience on your resume, and nothing can ever take that away. The deal could be the worst deal on the planet, but you did a deal. True. And so for me, it's a wonderful feeling. The day after we closed this commercial deal that we just did in January, the Saturday morning, I woke up and I'm kind of half awake, and I reach over and I start hitting my husband on the shoulder. He's like, what? I said, we did a deal. He's like, I know. I said, we closed yesterday. He's like, I heard. I said, no, I don't think you understand, honey. Our meetup did a deal. What other meetup has ever actually done a deal
together? Yeah, that's amazing.
Yeah. And for me, that was the most gratifying, enormous thing that we did, is we actually do deals. We don't just put speakers on and teach people how to syndicate.
And then try to raise money from you.
Exactly. Either they're trying to get you to turn into their bird dog to bring their deals to you so that you can help them put it together, or trying to raise money out of them, or whatever, which is what these gurus, why they teach in the classes, is because they're looking for deals and they're looking for people to put money into their deals. It's a way to grow their own business, which is totally fine. I don't have a problem with that business model, as long as we recognize that's what's going on. Most people who are in there will never do a deal. And most people in my club, we have 200 or something people in the club, and only I think 12 or 15 of us are actually in that club that did that deal. It's still a small portion of them that did it. But everybody else has $0 in it, and they've had a great networking experience. It's been highly educational, and they may or may not ever do a deal, but at least it's free.
And the opportunity is there for them to choose. So That's amazing. That's really cool and unique. And I think it's a great way for people to get started as a co-GP too, because it's really not that much risk, right? Because well, obviously a risk in investment, but I mean the risk from you're not like trying to find a deal, you're not trying to raise money and be a steward of someone else's money. You're essentially just putting your own money in, but then getting the experience of a co-GP. To me, that's like, because there'll be a lot of like gurus out there that'll say, you know, just be an LP and it's a great way to learn, you know, how to operate a deal. And to me, that's such a bold-faced lie, because as an LP, you don't get anything. You're not in any of the meetings. You don't know what it takes to actually, you know, once you put it under contract, to go through due diligence and then to actually close. You have no idea what that process is. You're just told, hey, we're going to close, so wire your money. And then once you have the deal, you just get like a monthly, you know, email, and then maybe a quarterly call. And that's not how you learn. So I think this is a really, really cool way to do it, because you're actually going to learn, like you said, you're on the asset management calls. That's where you truly learn how to operate a property. So that's really cool.
And we have had operators tell us that they're not interested in working with us because unless you can bring in at least $250,000, we don't even want to talk. Or we don't want to have that many people in our GP. I'm like, it's one entity, it's one, and you will never see us or hear from us unless we come to you. We assign a representative from the group to do most or all of the talking. And the operators we're working with right now are pretty laid back, and so they'll take emails from us, but we were trying to be we actually wrote up a little set of rules that I wanted me as the managing partner on this LLC and the managing partner on that LLC for the deal kind of sign and say, here's what we'll say online about this deal. Here's what we can't say online about this deal. Here's the access that we want. And here are the channels we're going to work through. And it was not exactly contractual, but it was a set of written rules so that we really had managed expectations on both sides. And everybody in my group reviewed it and okayed it before I signed it. And so just really managing expectations up front. Like I said, we've had a few operators who are like, no, you know, we don't really need help raising money, and I don't need to experiment with this weird thing that you're doing. But overwhelmingly, the response has been extremely positive and people willing to work with us. And for as low as $500,000, which I'm surprised. Our goal is to bring $1 million into every single deal. We're looking at our next opportunity right now, trying to find deal 2. And we're looking at an amazing basket of deals right now. And here's the thing I like about it. When the deals come to us, they're already through due diligence. They're already vetted. They're actively raising. I see a lot less crap than I saw before.
Right. It's already been vetted.
Yes, by experienced operators. And that doesn't mean they're all good deals and we want to invest in them all. Everybody has different goals. And some deals are barely making like our minimum benchmarks of what we're looking for as a club group. But for the most part, I think we've got 3 or 4, maybe 5 deals on the table right now that I would go into any one of them. I'm a base hit type of investor. Swing for first, and occasionally you'll get a home run. So these are all like swing for first or second kind of deals, and hoping some of them do better than that. But the nice thing about it is we're able to just sit down and be like, okay, what do we need to bring in? And a lot of them are institutional level, like $30-40 million deals. I'm like, what do we need to be able to bring in order to negotiate what we want to negotiate? And most of them are like, you know, $500,000. If you can do that, great. You know, we love your concept. We love who you're working with. You know, we'd love to work with you. Overwhelmingly positive response from operators.
That's awesome. That's such a cool business model. It's so unique and it makes perfect sense. It's a win-win for everyone. Well, I'm going to add you to my co-GP list.
Yeah. You got a deal we can race for. I think, and my purpose of getting the word out, when we first started this club, it was right after I lost that big deal that we lost last spring. And I really had to sit down and say, like, what am I doing? Like, why am I starting a syndication business? Like, I'm trying to retire my husband. And all I'm doing in the process of trying to retire him from his W-2 is creating a huge business and another job for myself. It's like trading his job for my job. And I said, you know what? I actually don't want to be lead sponsor on these anymore. I want more of a peripheral role. Like, I'll sign on loans. I have agency debt experience now, so that gives me position. We took all of the capital gains from the properties that we sold, and we actually put them into more liquid forms than reinvesting them into real estate, so that I have liquidity now. I can sign on loans. Really working on getting our net worth up to be higher so that we can sign on these loans, and putting myself in a little bit more of a passive, still go co-GP, but passive role. And I was like, and I'll raise capital. But then when I try to raise capital, it's a disaster. So I had to ask myself, like, what am I doing? Why am I starting this business? I could just put in money and be a limited partner. We have enough equity that if it could convert to cash, we could retire, at least, first base retire, right?
Yeah.
And so for me, it's like a way to stay active and keep sponsoring deals, but not as a main job and not as an active investor. So somebody was saying after we closed this deal that we did a month or so ago, they're like, really, thank you for putting this together. I realized it was a lot of work. I realized it was like herding cats, and for me, it was almost not even. It's like you have no idea how much easier it was to put this club together than it is to run an actual deal. And so for me, I'm relieved. I have a very small fraction of ownership, but I also did a very small fraction of the work and took on almost no risk.
Yep.
These operators taking on, but it allows me to be involved without being involved. And for people who are beginners and newbies, it allows them to be a little bit involved and get their feet wet one step at a time rather than swallowing the whole elephant at once.
It's so smart. It makes so much sense. And your term about herding cats, it's so true. Like every time and I've raised money from friends and family too. And you would think that it would be easier with them. No, it's actually worse. It's like, it from everyone, it's like herding cats. They thought they signed the documents, but they didn't, they thought they wired it, but they didn't. And Yeah. So I'm envious of that.
Well, when people ask you the question of what's your investing superpower, what do you say?
This is funny that you asked. So it used to, I was having a conversation with someone the other day. It used to be that I'm just relentless. Like I'll just do whatever it takes to get something done. And even if I trip and stumble and fall, I'm still going to go after my goal. And then I realized that is definitely a superpower, but my big superpower is what we talked about earlier. And that's being able to, take a bite bigger than I can chew and figuring out how to chew along the way. And that's what I've really has allowed me to grow.
Yep. And I would say that I probably would have said both of those same things about myself at one point in time. Relentless, being a problem solver, trying to figure out how to chew this elephant without choking on it. Like I have done that. And I felt like that was really, but you know what? After this experience over this past year, my superpower is herding cats. I have 6 homeschool kids. It's like what I do. My degree is in small business or entrepreneurial management. And so it's all about how to get all the jobs done at the same, just keeping everything running at the same time. And so for me, it's like, what am I really good at? That would be it. And it kind of goes back to what we were talking about before, like why I wasn't really promoting the club the first few months we were doing it, because I didn't know what I was doing. I didn't know if the club was going to work. I didn't even know if we were SEC compliant. There were just so many, and we tried to raise 3 or 4 deals, and they fell through on our part because we couldn't get everybody to sign the same operating agreement. We couldn't get everybody to agree on what we should be negotiating for. So with each deal we attempted to do, we learned a little bit more, and we got more cohesion as a smaller group, because it was kind of the same core people who looked at every deal that we ended up not investing in. We finally got one. It was like, okay, we've been around this before, and we were able to go move faster and faster and faster with each deal we attempted to do until we finally got to the point where we closed one. And now that we have proof of concept, and we've been kind of blessed by our securities attorney that we're doing this correctly, I really want to promote the club, because now we've got 4 or 5 deals in front of us that we could be doing. And I feel like 2 or 3 of them are pretty good. We just don't have enough people. We don't have enough people who can be decisive and make a decision. And we tapped out the cash of our core group who invested in the last one. They don't really have a lot of cash left. And can we raise money for this from our LP networks? Do you have to put money in order to get in? And answering all of these questions. Can we do another deal? Like how fast can we reboot and bring in another $1 million? The only way to do that is to build the club, have more people showing up and more people who can be decisive and say, yes, I want in on this deal. Here's my 50 grand or my 100 grand. I can go raise another 100, and being able to turn this over more quickly. Our goal is to do 1 deal per quarter, when that's still the goal. But the more people we have and the more people who are being decisive and being leaders, the more deals we can do, and the faster we can reboot, turn around and get another deal under our belts.
No, that's awesome. So it kind of sounds like you might be a capital raiser in the end.
Probably. It's like a side hustle. It's like a good retirement business. I want something I can do remotely. I want something that I can do without having to be on site at buildings. I want something I can do part-time. The goal was never to have a full-time business, and then it was moving that way. And I got to the point where I was like, I need to hire an assistant. I need to get an office. And I was like, just put the brakes on, screeching halt. Like, and I made a personal rule. This is going to be the opposite of what anybody tell you. I said, if I need to hire an executive assistant, then I'm working too hard and I'm done. I could be a lot more productive than I am. That was never the goal. The goal was to be less productive. The goal was to do less work, be more passive. So I just made a personal rule. I'm never hiring an assistant. And if I feel like I need to, then I need to cut back.
I think that's I'm glad you brought that up, because everyone, your actions need to align with your goals, right? And Emma's goal was not to create a business and a job for herself. It was to be able to have passive income and lead a more relaxed life. And she realized that wouldn't be the case if she needed an executive assistant. So all those listening, know what your actual goal is in life. And I don't mean business. I mean, you should start off, what is your goal in life? And then back into your business from that, and then back into your actions to be able to create that. That's how I do everything. If I want to do a certain amount of deals this year, I back into that, right? And my lifestyle, I back into that. How am I going to be able to create that? So I'm glad you brought that up. All right, before I let you go, I have 2 questions to ask. But before that, before I forget, how can listeners find you?
I am on Instagram at Passive Income Adventures, and that's just where I post pictures of what we're doing. We go to Mexico, or I take the kids to the aquarium, or I there's a little bit of real estate education in there, and a little bit of like, this is what your life could be like as a passive investor. So whether you want to be a limited partner or whatnot, it's more to inspire people to start thinking outside the box and thinking about how they can get passive income. And my husband still works a W-2. And so it's not like we're nomad traveling the world or anything exciting like that, but that's at Passive Income Adventures. And that's a little bit more personal. I tell more personal stories, family photos. Like I said, that's our journey to be getting passive income. On more of a business front, I'm on Facebook and LinkedIn. I spend a lot of time on both those places, and the handle is at whatever it is, Emma Powell 28. And that is where you can get in touch and learn about the club. I would say the club is really hosted on Facebook on my passive investing group. It's an event every week, and you can sign up there. We have about 2,000 members, and that's just over on Facebook. If you hop me over there, there's a link right on my profile to go join that group. And LinkedIn, I spend a lot of time on the boards, but LinkedIn groups and all that are no good yet. So mostly that's the way to chit chat on the feed. So those are my 3 main places. My website is highrise.group, .group. And that way you can sign up to schedule a phone call with me on my Calendly. You can get information about how to be a limited partner if that's more your speed, or I also have a page over there on how to join the club, and it has links to our weekly meetings and some other useful things over there. So depending on which way you want to go, limited or co-general partner, you can find that at highrise.group.
All right, final 2 questions. Emma, how has real estate and or multifamily changed your life?
I will answer that with a short story. I went to a mastermind. I'll give a little plug here, Zenith Mastermind. And I went to their inaugural event, and they had a Bridger Pennington speaking, who does the investment fund secrets Facebook group. And my husband made me go because he wanted me to learn how to start a fund, and he thought that would be an easier way to raise capital. So spending some time there with Bridger and his family, I just felt like, I don't really want to start a fund. It sounds like a business to me. It sounds like too full-time. And he just asked me, he said, look, what did you do before you were a real estate investor? I said, I was a real estate and wedding photographer. And he said, how much money could you earn there? And I was like, I don't know. I was part-time grossing like maybe 30 grand a year. And he said, well, and now as a real estate investor, you're still working part-time. I said, yeah. And what are you grossing now per year? And it was like, okay, this much more. And then he said, as a fund manager, you're going to blow the ceiling off of your earnings again, way up here. He said, why wouldn't you want to spend the same amount of time as a real estate photographer versus a real estate investor versus a fund manager? It's the same amount of time, but the ceiling is blown off of your income potential. When I first started real estate investing, my main goal was to never put us in danger of my husband getting laid off again, that I could at least run our family and pay our bills while he was looking for a new job, instead of it being this massive crisis, because in the tech industry, you get laid off all the time, right?
Yeah.
that was my first goal. But after doing it for just a couple of months, I realized that the ceiling on this income potential as a part-time job is much, much higher than my original goal of just making it so we could survive if he got laid off. It's like, I could actually retire him from his W-2 completely. And then after meeting Bridger, I was like, I could really blow the ceiling off of that again as a capital raiser and fund manager. And so that's how real estate has changed my life. It's changed me into a stay-at-home mom, homeschooling 6 kids, to being able to have much, much more income, still working part-time. And I'm at the point where I'm my husband's not retired yet, but I'm pretty much retired at this point, and I'm back to being a stay-at-home mom, and it's way more fun this time because I don't feel trapped. I don't feel like I have to do it. Like I don't have other options. So that's how it's changed my life. It's completely altered my perspective on my income earning potential, and then my relationship with my family and my kids and how I spend my time.
That's awesome and amazing, because I don't know how you do all that part-time. So my hat's off to you.
I don't have babies anymore. I don't have, my youngest is almost 10. So that does factor into it quite heavily.
Still, that's 6. That's impressive.
If I knew now what I knew when I was having babies, I would have spent all that time, instead of building a graphic design business, a photography business, I would have been building this business, still part-time, even with babies. And I would be a lot farther along than I am right now. I'm not saying you can't have babies to do it. I'm just saying my life is a lot easier now that I don't have babies.
Well, that kind of parlays into this second question. So this question is based on, because this show is based on not only multifamily investing, but personal finance, because that's my background working in financial services. So I always ask, if you had a time machine and could go back in time, what's the one piece of financial advice you would give to yourself, your younger self?
Don't work for your money. If you are working for your money, don't spend it.
Yep.
Take the money that you earn from your active job and invest it. And all that time that I spent as a graphic designer or a photographer, and if I was grossing, say, $30,000, $40,000 a year and maybe netting 20, 25, I could have, how many rental houses could I have bought per year at 25K? 1, 2, back at Texas real estate, back in the early 2000s through, 2010, I could have bought a lot of rental houses for 25K a year. And after a couple of years of that, I could have been doing all the stuff that I was doing on my business, the back of my business, taking my kids on vacation and piano lessons and horseback lessons and all of the things that you want a little extra cash for to just boost your lifestyle up. Let's pretend I wasn't even thinking about retiring my husband. I was just trying to make a little extra cash so we could upgrade our lifestyle. What if instead I had spent 3 or 4 or 5 years buying rental houses, and then off of the income from the rental houses is what we use to take our vacations and all that, building equity? That is a one big thing I would have done differently. If you're working for your money, don't spend it, invest it, and live off the backs of the investments.
Oh man, I think the same thing. And I try not to think about it because it makes me mad. But if I had done that when I was younger, especially in a city like Boston, and if I had invested in Boston, 10 plus years ago, I'd be in a completely different space. If I had, just not, gone out with friends and gone out to dinner as much and just, focused on that, I would be in a completely different place. But at the same time, I am happy where I am. But yeah, that would probably be my one piece of advice too.
But more so than going back in time, and here's the question I think, because I do get that question fairly often, but the question I never get is, what if you have done nothing? What if you can't go back in time? Because we can't. What are you doing now that is making that dream a reality, or making what you wish you could have gone back and changed 10 years ago? Are you doing it now? And I was just at Zenith, again, their event last week. And we had an experienced entrepreneur, kind of retired. He's just there, the kind of guy who's just there to give back and help people. And he was telling one of our table mates, she's in her mid 40s, she's the same age as I am. And she's like, I feel like we haven't done anything for a retirement. And he said, well, what happens if 10 years go by and you're in your mid 50s? He says, you feel like you missed the boat right now, but if you continue to do nothing, you'll be in your mid 50s still having missed the boat. And I felt like, so I shared my story with her. Like, I was 40, I don't know, 2 or 3 when I started this. And here I am, I'm almost 46 now. I felt like I missed the boat. At 40, I felt like I can't go back in time and fix any of that. So what's the point? But instead of feeling like I missed the boat, I got to work. And here I am just a few years later. Imagine where I'm going to be, where I'm going to be in 10 years. Get on the boat. Get on the boat. It's never too late, because those 10 years are going to go by anyway. And do you want to be in the same position you're in now, or do you want to be a late bloomer and just get started?
I think we should end it on that. I don't think there's a better way to end it. Take action. Doesn't matter when it is, as long as you're working towards what you want to work towards. Don't think about the past. Just get after it now. And like I always say, it's not what you make, it's what you keep. So then you can create the lifestyle you want, and you can live a stress-free life doing what you want with who you want. And what usually happens when that happens is then you start to give back to your community and others, and it just makes the world a better place. So stay after it, everybody. We'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is an investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.